As the stock market recovers from its crash, it becomes more and more important to do the proper analysis of a company so we can predict its future performance. So today, let's go through all the key fundamental checks to apply before you buy any stock on the ASX. As I mentioned in my videos before, the best free website to start with is marketindex.com.au. There's a link in the description. Let's use Wesfarmers share as an example. The share price of any company is the most sensitive to any news or announcements. You can see the price reaction to the announcements by clicking the Show News button. For Wesfarmers, the latest announcement of the conversion of Target stores into Kmart's was well received by investors and the price shot up. You can keep up with the latest news by joining Facebook discussion groups like ASX Stock Tips to get a feel for the upcoming announcements. Now, onto the fundamentals in this block that most people actually ignore. Let's start with EPS, or earnings per share. This is how much one share in the company will earn in a year. So if you buy one share of Wesfarmers at $40, it can earn you back about $1.90. That gives an earnings yield of 1.9 divided by 40, which is around 4.7%, which we can see in the next line. Obviously, the higher the EPS, the better, but also make sure the EPS is growing consistently every year. A company with negative EPS, for example, Polynova here, means that it is losing money. But that's okay, as long as it continues to improve year after year. Now, just because Wesfarmers earned $1.90 with that share, and you own that share, doesn't mean that you get the exact amount. The amount you get is decided by the board of directors, and for Wesfarmers, they decide that they will pay you $1.53 instead, as we can see in the DPS line here. That leaves them with a difference of around 40 cents per share to keep and reinvest, right? Well, that's not quite the case, because if we scroll down, we can see that the shares are 100% franked, meaning that Wesfarmers has paid the company tax of 30% on it already. That means to pay a 100% franked dividend of $1.53, Wesfarmers need to pay 1.53 divided by 0.7, around 2.18 of dividend per share, as you can see in the gross DPS line here. This gives us a gross dividend yield of $2.18 divided by $40 per share, which is around 5.4%. That's around average for a blue chip stock like Wesfarmers. Did you notice something strange? How can the dividend paid per share be higher than the earnings per share? Are they borrowing money just to pay the dividend? Well, no, and that's actually quite common. The reason is because the earnings is worked out after all expenses, including depreciation of assets, has been deducted, so their actual cash flow is actually much higher. Companies can also compensate for low earnings by cutting dividends, which is what the banks are doing, or remove it altogether like Sydney Airport has done for this year. So now that we understand EPS and DPS, let's have a look at some stocks and see if we can rate them using those figures. First up is the healthcare giant CSL. It has an EPS of 6.3 and a gross DPS of 2.9. That means that they have a very healthy cash flow and can easily afford to pay the dividends for many years to come. This is a good sign of reinvestment back into the company for its R&D activities, which is critical for Australia's leading healthcare company and ensures strong growth into the future. Let's have a look on the opposite side of the spectrum. CIM is a stock that has struggled through the years, and it's easy to see why. With a negative 3.2 EPS and 2.2 gross DPS, CIMIC would have taken a hit to its cash flow this financial year and may take some time before it can recover properly. Now, let's look at the accounting software company XERO. It has never paid any dividends and has a very tiny EPS. So purchasing one share at $85 will earn the shareholder only 2.3 cents. Something like this will warrant further investigation before investing in this company. If we go and look at their annual report, we can see that they've actually gone from a loss of $27 million to a profit of $3.3 million this year. So we actually caught them right on the borderline of becoming profitable. And you can see that from the price surge that a lot of investors are expecting big things from XERO. Finally, let's have a look at the small cap company PDI, Predictive Discovery Index. At first glance, the price chart looks very strange, especially with the double whammy of the negative EPS equating to a loss of around 7.7% per year and no dividend payout. If we click Show News, we can see the announcement right at the bottom of the price jump that there was a trading halt, followed by news of a new gold discovery in West Africa. You can actually see a similar thing happening in June of 2019 with a trading halt, announcement, and its corresponding price surge. This is the type of thing that a share like PDI thrives on, rather than following its EPS performance. And that's part 1 of my guide to picking the right stock using market index and fundamental information. Make sure to like and subscribe to get notified when part 2 is released as we dive further into stock analysis for better and healthier future investments.